What a month is just behind us. It started with the Liberation Day, where President Trump made the long-announced statements regarding the tariffs. And this was a shocker for many countries. From a European perspective, not that much. But we have seen that the tariffs regarding China were way higher than earlier announced, and that the tariffs regarding Mexico and Canada were still in place. This had some chaotic developments on markets as a consequence. And while President Trump said at the beginning he does not care, we saw then a few weeks later that he did care. And so he moved back in some of the areas. Now we have a moratorium where we have 90 days to make negotiations about new trade deals with many countries. We doubt that this will be successful. So the uncertainty regarding the tariff outlook will remain in place. Furthermore, the already announced tariffs begin to work. And we will see this pretty soon in the inflation and economic development data. And with this in mind, we have revised our US forecast. We now only expect 0.4% growth in terms of GDP in the US in 2025, and we have increased our inflation forecast to 3.7%. So this is a very unfortunate mixture for the central bank, which has its targets to remain full employment and low inflation. And we think, when in doubt, the Fed will go for price stability. And therefore, we do not expect that the Fed will cut rates this year. On the rest of the world, the US measures have an implication as well. When it comes to Europe, as I said, we do not see a huge surprise in the tariff announcement, and therefore the implications are relatively mild to our projections we had in earlier. Nevertheless, we revised down, because of the global impact of these US tariffs, our growth forecast from 1.0% for 2025 to 0.8%. In contrast to our earlier thoughts, we do not see any escalation in trade conflicts between other countries. We even see more ways to find alliances on the trade level, and therefore these expected measures from Europe to raise taxes, for example, against China to prevent the inflow of cheap products did not take place so far. So overall, in Europe, we have the same direction in the movements of the inflation and the growth forecast because of the, at least for some time, reduced inflationary pressure. The ECB has now room to cut rates again this year. Actually, we now expect a further rate cut in June by 25 basis points. All what happened in the last couple of weeks and months, because we had in March this big fiscal program in Germany as well, we have revised our long-term forecast as well. So looking through this, over time we have a higher growth outlook in Europe, and therefore the ECB is likely to go back on a higher level of interest rates at the end of 2026. Regarding the US, there will be a new Fed president after the term of Jay Powell ends in May 2026, and we think that the new, more Trump-loyal US Fed chair will cut rates then in the second half of 2026. Now, in the near term, after this very eventful month of April, what are we looking forward in May? We will get a new German government, and there's probably the election of a new pope. What is likely to stay is the uncertainty in US politics, which is likely to cause more volatile developments on capital markets in the month of May.